Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right into one of the most structurally complex and, frankly, psychologically fascinating case studies in the microcap market right now. Powerbank Corporation, ticker SUUN. The volatility we saw in December of 2025 was nothing short of a perfect storm, and it really crystallizes the central conflict here. We saw the stock spike, hit a high of $1.92, only to close way lower, for example, at 164, often on volume that was 10, even 20 times its normal average. And all of this while seeing huge off-exchange volume, in the dark pools. So the big question we have to crack is whether this stock's valuation is anchored by the tangible, successful $41 million solar asset sale, the legacy thesis, or if its movements are just driven solely by this high-concept, totally unproven pivot into orbital cloud infrastructure, the speculative thesis. I'm going to argue that the solar business provides an essential financial floor that dictates the company's real defensible worth.
See, I come at it from a completely different angle. That extreme volatility, the spike and fade price action you just laid out, that's all the evidence I need that the fundamental floor has been, structurally ignored by the market, by momentum traders. If the fundamentals actually mattered, the price wouldn't swing so wildly on hype cycles. I would argue that the speculative narrative, this high-risk, high-reward bet on space and AI, is the sole overwhelming driver of everything. The trading volume, the momentum, any potential for multiple expansion. The company's strategic shift has just fundamentally rewired the psychology around this stock, making the proven solar assets almost, irrelevant to how it trades day to day. The market isn't interested in asset value. It's interested in the story. Okay, well, let me lay out the argument for that floor. If we strip away the narrative just for a second, the market has assigned this deeply unfair uncertainty discount to SUUN. You can see it clear as day in the financials. The stock is trading at a price-to-book ratio of 0.47. So to be clear, that means the market is saying you can buy $1 of the company's actual physical assets, real solar panels, development rights, contracts, for 47 cents. That's a wildly pessimistic valuation, basically half its liquidation value. This company's core value is its proven ability to generate non-dilutive capital, and we have concrete evidence of exactly that.
I'm talking about the announced $41 million transaction with Solar Advocate Development, LLC. That involves the sale and construction of 3 community solar projects, totaling about 16.87 megawatts. This deal is absolutely crucial because it validated the asset value at roughly $2.43 million per megawatt, which is a very, very healthy metric, especially for the competitive New York market. This is a massive liquidity event. It provides predictable, high-margin revenue for fiscal year 2026 from the EPC contract part of the deal, and maybe most importantly, it gives the company the capital to potentially deleverage its, $53.62 million debt load. That cash injection secures what analysts would call the bear case floor, somewhere in the 120 to 140 range. And that floor is built on a real executed deal.
I'm sorry, but I just don't buy that the $41 million deal, a deal involving assets they were selling off, by the way, is what took the price from $1 to $1.92 in a few days. The trading activity we saw in December, that's purely psychological. It's driven by waves of retail sentiment chasing these, moonshot tech plays. Let's be honest, the market isn't rewarding a deep dive analysis of New York State's solar incentives right now. It is betting on the bull case. And for those traders, that starts at $6 and goes up, and it's based entirely on the narrative. The real evidence here is that radical strategic pivot in Q4 of 2025. The company shed its old identity, SolarBank, and became PowerBank. It aligned itself with this explosive AI energy nexus through the orbital cloud, D-Starlink, and D-Star AI. That rebrand completely shifted the investment proposition. It's no longer being evaluated with a conservative, discounted cash flow utility model, which, gets you low single-digit returns. Now it's a venture capital-style bet on exponential growth in space and AI, and that attracts the exact kind of trader who cares about the narrative ceiling, the potential 10x return, not the fundamental floor based on old solar earnings.
I see why you think the narrative is paramount. But I look at that speculative ceiling, and I see something built on a dangerously unstable foundation. Let's just focus on the credibility of the two business segments for a minute. The solar business has a proven track record. They build and sell valuable assets. But the Orbit AI venture, based on the material we have, is just riddled with due diligence red flags. The partner, SmartLink AI, has no verified aerospace history. The CEO's digital footprint is, well, opaque. But the most damning fact is the capital mismatch. Launching even a modest low Earth orbit constellation, that takes billions in capital. Just for R&D, manufacturing, launches, and PowerBank's initial commitment to this venture, $50,000, with an option for $10 million later. $50,000. For a space venture, that's an infinitesimal commitment compared to the scale of what they're claiming. I mean, that doesn't suggest a serious, capital-intensive business. It suggests the partnership is a low-cost, high-leverage narrative warrant. It's designed purely to capture buzzwords, AI, space, crypto, to drive fleeting retail interest. Is this a serious business plan, or is it a press release strategy to distract from that 0.47 price-to-book ratio?
Fair enough. I can't really argue with you on the technical feasibility side. You're right. Launching and maintaining infrastructure in LEO is extraordinarily difficult. We all know the reality of radiation shielding, managing latency, maintenance. It makes the whole orbital cloud concept extremely challenging, even for the big, established players. But you're focusing on the feasibility when the market is clearly rewarding the success of the pivot. The narrative worked. The rebrand achieved its goal. It successfully moved the entire market conversation away from all the boring industry headwinds. Module tariffs, interconnection delays, interest rate sensitivity, all the things that depress solar stock multiples. It shifted the conversation entirely to high-concept, solar-powered orbital data centers. So from a strategic market perspective, PowerBank successfully decoupled its valuation from the cyclical, complex world of pure-play terrestrial solar. And that shift is the engine driving all this retail interest and volume. It doesn't matter if that $50,000 can actually buy a single rocket bolt. The market is betting on the story.
But if the market is purely divorced from reality, then how do you explain the lack of sustaining power? If the story is so strong, why didn't the price stay at $1.92? Why did it crash back down to $1.64 almost immediately? I mean, wouldn't a purely narrative-driven stock hold its momentum longer if the story was really believed?
I think that speaks to the exact structural mechanics we need to talk about next, the market microstructure. That lack of sustainability is a feature, not a bug, of how this stock is traded. We consistently saw huge off-exchange trading volume in December, right? Often bouncing between 50 and 75%, all executed in dark pools. Let's pivot from the balance sheet to the actual mechanics of the trading floor. My argument is that this high internalization, where large wholesalers use payment for order flow to fill these massive streams of retail orders off exchange, it means the price is structurally fractured. The fundamental analysis, like the asset validation from the $41 million deal, becomes less relevant than the transactional flow. Price discovery is being driven by market makers capturing the spread on volatile flow, not by institutions making, directional value-based bets on that $2.43 million per megawatt valuation. This structure inherently favors quick spikes and rapid fades because the true institutional conviction just isn't there to anchor the price.
That's an interesting point, though I would frame that dark pool volume a bit differently. I think we need to apply some nuance here to avoid the common retail form conclusion that this is automatically some kind of institutional suppression. While it's true that high off-exchange volume comes from wholesaler internalization, in a retail-heavy high-volatility stock like SUN, the high reported short volume is often just a proxy for high retail buying pressure. Market makers are shorting shares to fulfill those buy orders instantly, then they go and find the shares later. They're acting as liquidity providers, not necessarily as institutional bears trying to crush the stock. And besides, the real structural stability is being provided by the fundamentalists, the management team. Consider the timing of their operations. PowerBank announced the safe harboring of 15 projects in December.
For anyone listening, safe harboring is a sophisticated financial move where you lock in the 30% investment tax credits before the year ends, securing those huge subsidies. This action de-risks their entire 2026 pipeline and supports that base valuation. This focus on complex tax equity planning proves this isn't just a narrative shell. It's a sophisticated developer securing tangible, long-term value, regardless of the speculative flow on any given day.
I'll grant you that safe harboring is smart financial planning. It's good business. But the fact that they're simultaneously chasing a Leo fantasy with $50,000, a sum that wouldn't cover the rent on a launch bay for a week, it completely undermines the stability you claim the solar planning provides. If they were truly focused on sound fundamentals, why pivot so aggressively away from that proven model? They made a strategic choice to court the speculator, and that decision defines the stock's character now.
But that choice is being diluted by a unique psychological factor here. It's what we call ticker dyslexia. This confusion is actively stopping the market from correctly pricing that low price-to-book ratio. There is widespread confusion conflating SUN Power Bank with SOUN, which is SoundHound AI, a stock with massive short interest that retail traders are targeting, and also with SUUN, SUNation Energy, which just announced a massive 200-for-1 reverse split. So I'm not convinced that the narrative alone drives everything, because this confusion causes erroneous short squeeze speculation based on SOUN's data, and more dangerously, it causes panic selling based on the fear of a reverse split that only applies to SUNE, not SUN. The legitimate value from the solar business, that $2.43 million per megawatt valuation, is being actively suppressed by retail fear stemming from completely unrelated companies. This isn't a sign of a weak floor, it's just external overwhelming noise.
That's a compelling point about the ticker confusion. But I believe that contagion, this ticker dyslexia, isn't some external anomaly. It is an inherent feature of a purely narrative-driven stock. I mean, think about it logically. If the market were truly valuing the assets, if that PV of 0.47 were a strong, stable anchor, then confusion over peer tickers wouldn't cause these instantaneous volatile reactions in SUNN. Investors anchored to the asset value would just buy the dip. The very fact that SUNN's price is so highly reactive to headlines about other companies demonstrates the fundamental weakness of the floor. It shows investors aren't buying based on balance sheet conviction, they're trading on psychological triggers, on fear of missing out, or fear of dilution. The market is treating SUNN like a volatile tech lottery ticket that's tied to a whole basket of other volatile tech names, not a stable infrastructure play. For the momentum crowd, the volatility is the value proposition.
We keep circling back to this tension, don't we, between the proven financial event and the unproven speculative claim. And ultimately, I keep coming back to the fact that the $41 million Solar Advocate deal is the only verifiable truth we have when assessing PowerBank's financial health. The successful execution of their pipeline, the validation of that asset value, $2.43 million per megawatt, and the sophisticated tax planning. These things define the actual measurable financial health of the corporation. These factors should guide any sober investor toward that base case valuation, somewhere in the $350 to $475 range. Everything else is just conjecture built on a $50,000 down payment. And my conclusion remains that PowerBank is currently trading and will continue to trade as a speculative thesis vehicle. The pivot into Orbit AI succeeded precisely because it moved the stock into that high-risk, high-reward quadrant, and it got the attention of momentum traders. This lets the price detach completely from its underlying book value and trade based on whether the market assigns a venture capital multiple to the narrative. And the outcome, the success or failure of the stock from here, it all depends on one single factor: capital allocation.
Exactly. Whether the $41 million they generated from the reliable solar business, the foundation, is going to be reinvested responsibly into more profitable solar growth, or if that cash will be diverted to subsidize the high-risk, unproven Orbit AI venture. The complexity is inherent.
An investor has to hold two opposing thoughts at the same time. That PowerBank is a deeply undervalued solar developer, you can see that in its book value, and at the same time, it is a highly speculative, narrative-driven startup looking for a space-age multiple.
Right. And the true path forward lies not just in looking at past fundamentals, but in closely monitoring the balance sheet from here on out. The immediate use of that $41 million in liquidity. That allocation decision is what will ultimately tell us whether the fundamental floor or the speculative ceiling determines this stock's future.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.